So it's the third session of our series, Ready When You Are, Use Opportunities Now. In this session, we will show you the international capital view on German real estate markets, what opportunities they are searching for and what they expect for the future. Germany was usually for a long time, the safe haven market globally. Likewise, offering great upside if you had asset management strategies or just playing the cycle and using the high liquidity in this market to exit. 2019 was a great time to exit. 2021, a lot of you know that. So, however, the ECB's turnaround in the interest rates and the currently measurable recession in our economy is dimming the mood. And the question is now, how can international capital contribute to more market dynamics? What asset class risk profiles they're searching for? We have a great guest speakers here from, I would say, all compass directions. And very pleased to have this. Important for you, you can raise questions to this session throughout the session, and we will answer them to the end. So please feel free to shape this. And sorry for the inconvenience. And now we are starting. Happy to introduce my guests, representing, as I said, different investment strategies from different regions. First of all, Anni Hönicke. She is Managing Director of GII Asset Management Advisory. GII stands for Gulf Islamic Investments. So Anni is representing the Middle Eastern capital view here. Before GII, she was in several positions at real estate companies, and amongst them 12 years, she was global head of real estate lending at Dicker. So we also have a finance specialist in the group. Very good. Great to have you here, Anni, and looking forward to your experienced view on the market. Next, Marion Lemoine. She's director real estate at Sofidy and brings in the French perspective to the German market. Sofidy has about 9 billion in real estate under management and a clear focus on offices. Marion and her team, have been very active. We saw them a lot. They bought assets over the past 12 months when others were holding back. So very interesting to hear from Marion how they look at it and why, and what's the French perspective on the market. Next, Paolo Rosso. He's partner at LCN Capital Partners and takes a private equity investor's view here on the German real estate market. And he has a special focus, which is single tenant transactions, longer lease terms, so kind of like sale and leaseback transactions in Europe and North America. Given the interest rate shift, very interesting. This should be the most affected, but very eager to hear you, Paolo, what this makes with your business. And last but not least, we have Wolfgang Ködel here. He is as head of Nrep Germany. He started this new position just in July, so we get him really fresh in here and hear a fresh new view on the market. Previously, Wolfgang was managing director at BlackRock for about 10 years. And Nrep, for those who don't know them, is a Northern European investor headquartered in Stockholm with 19 billion assets under management, 8 million square meters. So the square meter seems to be quite cheap in your portfolio. It's great. And Nrep has an interesting guideline to investments. They say, we are strongly committed to the sustainability of real estate business, and we always see real estate in the context of urban development. So very eager to hear your view on that and how this works in the market. Let's start the discussion, first of all, to get an overview where everybody's coming from. It's always good to hear what is the home market and how does this transfer into the German market. I would start with you, Anni. You looked at opportunities in Germany the last couple of years. What's the current market environment in Abu Dhabi, where you're based, or your investors are also from there, in terms of yields pricing, and how does this transfer to the German market?
Yeah, let's go for a moment to Dubai, Abu Dhabi. So the commercial real estate market in the United Emirates is characterized by strong macro factors, and you have strong demand from tenants and also from investors in the office sector, in logistics, and you see yields for grade A offices of 7.5%. Logistics warehouses 8.5%. And normally you see 3 to 5 year leases with credit tenants. And on the back of this, when we invest in our home market, we can really deliver to our investors what we promise, which is superior returns, which are risk adjusted. And what does this mean for our perspective on Germany? So Germany as a market was always on top of our list. So of course we like strong economy and the transparency and jurisdiction safe, everything good. But from 2019, Germany was too expensive for us, at least for office and for logistics. Or take it another way, we were always outbid. Which means, we were closed out, so we did not get access to the deal. So we were absent for so long time until the Ukraine war started. And since interest rates have gone up, since inflation has kicked in, or the other way around, we see transactions, and we are back on the radar for agents, for sellers, for all market participants, and we studied many opportunities. Yes, and we are still a big fan of Germany, and but Germany has changed. We think the market has not fully corrected. There is a little bit truth when we say Germany is the sick man of Europe. And but still, we are interested. We like Germany and its big urbanizations in the big cities. We like the corporates we have here, the Mittelstand, and we want to demonstrate again that we are a reliable partner when we do a deal, but not at any price. And I think we think the market has not fully corrected, and that's what we are waiting for.
Okay, great to hear that. I would go over to Marion. Marion, so you're looking from the French perspective on the market. How is this compared to your home market at the moment and the German market?
The German market starts to reprice a little bit earlier than we did for several reasons, but at the end it starts to be a good opportunity for us to come in Germany. We already were there, but we just reinforce our position in Germany as we can afford now A city. For the previous year, we were only on the B cities because it was too expensive for us to go on the best location. Now we can afford A cities, so we are absolutely happy about that. The main difference between Germany and France, only on the real estate market, is we have only, let's say, 2 really strong markets in France with Île-de-France and Lyon. And Germany, you've got a really great balance between several cities, which open to us a lot of opportunities to find great investment on a really good condition with microeconomic figures, growth of demographic figures. So we really like Germany for that. It's one of our main targets in France. So we were quite active this year. For the past 12 months, we bought one portfolio of B&B with 6 different hotels, and we bought an office building too. So we want to be on the ball and to try to catch the good opportunities. We are maybe doing 2 other deals. So at the end, we've got a little bit more than 400 million under asset management in Germany. And we really want to increase this one maybe to 600 or 700 million. So we try to find opportunities, and we are really cautious about the market, and we try to find the correct net initial yield that we can catch on the opportunities.
Interesting. And does this also is the same for your peers from France, or how would you rate this against the other French investors?
It depends. We've got one big advantage here in comparison with some of Alter Ego. We are full cash. So that means for now, we have a little bit more than 700 million to invest, which allows us to have a look on a lot of opportunity. But we didn't invest a lot from the beginning of the year. We don't want to catch a falling knife. So we try to just have a look, to be smart on our opportunity. We want A location, we want CBD, we want main street and main location, we want strong tenancy schedule with good covenant. So we are really sharp on our criteria, but we have some money. We want to invest, and as I told you, Germany is one of our main
Awesome. So a little bit similar with Anni, falling knife, so still a bit cautious. How is this with you, Paolo? So you're from the private equity side looking at this. We see a lot of like crashing things at the moment in this market, developers crushing. People need to shift money into other asset classes. How do you see the market at the moment, the German market?
So Germany is one of the markets we are looking at in Europe. We look at all of Europe. So Germany is one of the pillars or one important market for us. What we have seen over the last years is that it has been, we have seen a lot of opportunities, but some of the things Anni and Marion have said resonate with me. So it has been difficult for us to find the right opportunity for us, which is accretive to LCN and to our investors. So the market has been very expensive, and we haven't been able to be very competitive on the opportunities we saw. This somehow seems to change. We have several new transactions on the table, which fit our criteria as a net lease investor and sound interesting in terms of yield requirements. This may have potentially has also to do with the fact that there's a stronger differentiation between asset classes. So as a net lease investor, we also invest in, light industrial properties. And I think in the past, because people were searching for product to invest, there was a bit of an overlap. So we had much more competitors in our sector, which we were not expecting, and that has had a significant impact on pricing. And that's, I think, why in the past we had less opportunities we could really pursue, while this has changed in the last 6 to 9 months, I would say. So Germany is an interesting market for us, and we will look at more opportunities.
Anni touched the point Ukraine when market changed, of course, in terms of pricing and made it more attractive for money which needs higher returns. How is Ukraine in your analysis? How is this playing a big role to investors?
It plays a role, like all geopolitical changes. Our properties are single tenant properties, so there's one company I need to look at, and if there's something major happening in the world, we need to understand how this could impact them. From a real estate perspective, obviously, if I have a property close to an area which is becoming difficult, obviously that has a direct impact on my asset. But it is more than just that, right? So thinking about supply chain issues, which we had, suffered over the last years, this could have an impact on the financial situation of a company, which is potentially a tenant in our properties. So we do monitor Ukraine and geopolitical changes very closely, and try to understand how this could impact our strategy as well.
And it can bring more business in terms of onshoring. A lot of people speak about that. Yeah, great, Wolfgang. A little bit. That's very interesting from the Nordics. Long seen as a very safe haven market, but quite closed shop. Would you agree to that? Is this a closed shop, and is Germany more open to international capital?
Yeah, well, I think if you draw the comparison, and maybe starting with the point that Nrep is a market leader in its home markets in the Nordics, which is where the vast majority of our 20 billion of AUM and 700 employees in total are located. Yeah, if you draw that comparison, obviously you see the Nordics in very idiosyncratic structures. Denmark is different to Sweden, Finland, Norway, and only 30% of the population compared to Germany. Yeah, so that while this is an economic bloc, yeah, you can't compare that to a economic region like Germany, which is much more homogeneous. So what I would say is it's probably from an international capital perspective easier to understand to invest in Germany versus a more fragmented market. But Germany has similar characteristics. You also, we've already alluded to the polycentric structure. We've alluded to the fact that these regions have different economic drivers. So I would say in its totality, it's easier and it's more open, and hence why you would expect that also more capital is able to tap the German market versus the Nordics. And for us in Nrep, that is also the reason why we do look at Germany as a natural way to move our growth into the region, because it is the largest European economy, because growth is somewhat limited in the home markets, where Nrep has explored already a lot of these things.
Mm-hmm. Interesting. And there are more to come from Nordics. What do you think, dear? That other competitors of you also will join and do more activities in Germany?
Well, I think obviously you have the large residential players in the Nordics who have already kind of years ago started to be present in Germany. So I think that's probably nothing new. What I would say now is that these markets are at different points in the repricing. Yeah. So, for example, we at Nrep have started to invest again into the Swedish residential market during the summer by acquiring a majority stake in
against the cycle or against the market.
Exactly, and you would probably arguably say that Germany is still a bit lagging that trend of repricing, as panelists have alluded to. So, hence, yes, there are Nordic investors probably looking at Germany, but you need to be mindful of investment timing in where you invest at the moment in Europe.
Great. Very interesting, really. I think what is now interesting that we go to a chart where we show the inflows into Germany. So I hope this is now getting into to the viewers that they see this. So what you see there is kind of like what was the foreign capital flow from 2018 to first half of this year. And it's a little bit complicated, so quickly explain this. So you see Americas on the left-hand side, what kind of the bars, how big they were, that much money was invested into Germany. Europe is everything apart from Germany, so also like Austria, also Spain, of course France and so forth. And then we have APAC region and the MENA region. MENA region, Anni, unfortunately, very thin, very thin, tiny bars. So I would love to have more. And also interesting, like the risk profile. So where you have in Americas, you have a majority of private equity you're looking for. So that's rather value add style. In Europe, it's very even between the different risk classes. If you look at APAC, almost the majority is really safe haven stuff. So they want really core and be safe if they invest so far away. And MENA, interesting what you said, Anni, so more value add. There's a tendency for value add because they need probably against 7.5% prime yield to show something which is attractive. And on the left-hand side, you see the transaction volumes for those years. So the share of foreign capital was always something like around 40%. Unfortunately, the first half a little bit below that. But we expect to come more, especially if we hear you. Do you see yourself represented into this? And just a quick comment from you, Anni. Yeah.
Represented, you mean now or also in history? So when I go back in 2018, so in 2018 we were invested, and we were invested in logistics, and most notably we had one big Amazon fulfillment center in Dortmund, and we sold this in 2019. And so somebody else on this bar bought it in 2019, and this was an irresistible offer. And this also earmarked the moment in time when Germany became too expensive, and we stayed away. Also, when I look at the other countries here, so also we like France, and our biggest transaction we did in 2021, which also proves we during COVID we invested. So the biggest transaction we ever did was in Paris Montreuil, 250 million, an investment with which we are happy. And now I hope that we can lift the bar again and do more in 2024, perhaps.
That's our hope as well. Great. So let's then zoom after this into the investment styles and acquisition profiles of you, which is, yes, quite some characteristics, of course, you have, and different ones. So which asset class, again, Marion, are interesting to you, and what do you think from your other French investors?
Our primary DNA is retail, so it will remain retail. And in those peculiar time, I think we will come back to our roots, and we know this asset class. And at the end, the net initial yield correction allows us to come back to great high street retail. So we are quite positive about that. Otherwise, as I mentioned, we also do offices. We did hotel last year, and in our current criteria, we also have last miles. We've got retail parks. We've got DIY, for example. So we are, except residential and shopping center, I think we are looking for all asset classes as soon as it just respond to our criteria. So they are quite simple. We want unquestionable location. We want to be for offices, for example, on the CBD of each town. So A cities or best B cities. We want for the high street being on the main street of more than 200,000 inhabitant cities with a strong demographic increase and positive economical dynamic. We want, as I said, really good tenancy schedule. We are long-term investors, so we want long-term, mid or long-term term lease with rent at the ERV or under, if it's possible, because one of our main focus is the rental liquidity of our opportunities. We are doing the asset management for France, and we want to be sure that we can distribute during all the detention period of assets. So at the end, I think we are quite simple in our criteria. We were core plus, we became core investors. And the correction of the yield now allows us to be a core investors and to secure a little bit our investment and to improve our portfolio.
Interesting. So core investor, but of course pricing must give cash flow, I guess, yeah. Wolfgang, to you, we had this very interesting criteria, sustainability, very committed to that, and always in context of urban development. How do you now go to this market? You're starting new, and how do you source and what kind of opportunities you're looking at?
Maybe starting with what kind of capital do we have available? So we just raised the largest European value add fund to date with 3.7 billion of equity. So combine that with leverage, that gives us sufficient dry powder to exploit markets in the years to come. And this is quite fresh. So we have a lot of duration on that fund. Now, if you obviously our mission statement, which is embedded in the founding criteria of Nrep, is that we want to be customer-centric and that we want to improve cities. And this is basically what determines all our investment strategies. But what does that concretely mean for Germany? So 10% of that fund, roughly, we want to deploy in Germany. And we have started to invest there. We are thematic, That means that we like to do partnerships and strategies which we think are undersupplied and where we think that our own decarbonization goals can be achieved by delivering a product which resonates very well with our clients. And that is mainly in the living sector, that is in logistics, and this is where the vast majority also of our Nordic assets is allocated to. And on a select basis, and there I would agree with Marion, that we are much more selective in the way we go about offices, and if you decompose these three strategies, we want to do them with partners. Why? Because the money which we want to invest is at scale, and we want to invest at scale. But we don't want necessarily to do just big investments. We want to do strategies when it in itself can be granular. So that means for living, green, multifamily, new builds in cooperation with developers. The market is not there yet, but we think it's a long-term strategy. On logistics, we've started the first 2 joint ventures with partners and started to invest there. Speculative logistics developments, so buying site with building rights. And in offices, it's brown to green transformations. And honestly, I think there's plenty of space in Germany to play on that theme, because even if you limit yourself to big cities like Munich, Berlin, maybe Hamburg, and go in central locations, there are there's enough stock which needs to transform, which needs to be taxonomy conform, and it also brings an additional benefit to us as Nrep, which pays on our decarbonization goals. The embodied carbon on the brown to green is super important for us, and since the new build will always have a worse impact from that perspective, it is something where we definitely want to go along in that strategy.
Interesting, very interesting. Paolo, would like heavy asset management approach, I would say. Is this also in line with your strategy? Would you partner on things with Wolfgang?
Yeah, I guess our leases are structured in a way that our asset management involvement is, less significant opposed to what Wolfgang just explained. So we have triple net lease agreements, which means that our tenant partner basically takes care of the property. So we don't have an internal property management team or asset management team. It doesn't mean that we don't look at our properties. We definitely are there, and we are on top of things, meet with our tenant partners, but we also look at the properties. But compared to what Wolfgang described, our asset management is probably less.
Christian, before the opportunity goes away, coming to new investments, so I would like to mention something which is important for us currently, which is credit investment. So we think it will take some time. I'm a little bit jealous on you, what you already have at hand and how quickly you will be able to invest. But what I think is very important currently in Germany is that liquidity for upcoming refinances is available, and that is something which interests us. So we would be ready to go into mezzanine and even better, or from my perspective, even more attractive whole loans. Of course, we rely on a strong underlying asset, and you have to be disciplined in your underwriting. It has to be like underwriting a property. But I think that is something which is urgent and where we can come to the table quickly.
Interesting. How much have you raised and want to invest in Germany? Because we had heard already some figures here.
Yeah, so we are still raising capital for our most recent vintage. So we are investing for LCN fourth flagship fund, and that is agnostic in terms of asset classes, but also in terms of location. So we don't necessarily say 10%, 15%, 20% is for that country. We don't have that. But Germany, as I said before, is a very interesting market, and we invested already in Germany, and we will continue doing that. But it needs to fulfill our criteria in terms of return, but not only. The asset class is important, obviously, for us, even though we are asset agnostic. And most importantly, is the credit underwriting for us. That's where we start looking at things. It's always single tenant. The best lease agreement is not good enough if the tenant is not there in a year. So that's where we start looking at things. But there, to answer your questions, we have many millions to spend.
So, and you said you see more competitors coming. So that means, on one hand, of course, pricing is rather went down the whole time. Now it's going up again.
I see yields going up. I think what's happening, and we are not there yet, this process to be concluded, or to call it concluded, is that there's a stronger differentiation in terms of asset classes. So what we saw in the past is that, a logistics property, or light industrial property was probably confused with a logistics property, which is different. So we saw much more investors looking at that, and that had an important impact on price, which became then which brought us to the point that it didn't make sense for us to look at it anymore. So I think that process is still ongoing, and I think it has been said already by the panelists before. There's still something ongoing on the market, and prices, in my view, are still not where they should be in order to be accretive to certain investors, including us. But this is happening right now.
What's the yield level you want to see on different asset classes?
That's an interesting question, and it depends, because it depends also on the tenant covenant, right? So as I said, it's always one tenant, and the quality of the tenant is to some extent also determining part of the price. It's not just the asset. So giving you just a fixed number if it's office and in that location in Germany and is probably wrong. That's probably wouldn't cut what I'd like to say.
Great. So you need an advisor to bring you in there.
I guess you know somebody.
Very good. Yeah. Good. I think that was very interesting. So we have a lot of capital here. We have a lot of different strategies and covering non-resi, covering resi, and so it's kind of like all asset classes, credit as well. So this is quite a great group. So we could do some deals together here, certainly. Let's go to the outlook. So how is what do you expect the market to move into? Of course, hopefully then contribute more to the dynamics here. So Wolfgang, it's you set the number. What is it about? If I take 10% of what are 6 billion or 600 million you want to invest, is it? Yeah, but leveraged, so it's much more. So is this like for the next 5 years, or is it like for this year? Or
yeah, this capital is there for the next 12 to 24 months, and then we'll probably kind of go out and raise the next vintage. Yeah. So in terms of, if you ask me about the outlook and how we see the market, as I said, we've started to invest. Yeah, and there you probably see also the differences in the respective asset classes. Logistics is plateauing a bit, yeah. So people get behind the idea of the structural shifts, yeah, in logistics. Hence, feel much more comfortable doing logistics deals. That makes it more easier to underwrite, yeah. It gets super difficult when you go for the living sector, yeah, because the fundamentals are on paper great, yeah. So you have an undersupply. There's a true need for more space, as we all know. But then you have very difficult capital markets. Yields were lowest. The repricing is really painful. And I think on offices, it's really kind of getting hit on both sides, isn't it? Yeah. So you have a very hefty repricing on the yield side due to the interest rate hike, but then you have the cyclical downturn due to the economy, and the structural downturn due to working from home and new work. Yeah. So That doesn't mean that we will not invest in that sector, but this is probably kind of categorizing and prioritizing how we would go about investing in these three investment themes. Yeah, and therefore, I think for the next months, what we will see is that investment volumes will still continue to be below average. Yeah, but that investors will gain confidence on the plateauing of yields, given where the central banks have placed their communication.
Interesting. Paolo, you said you don't want to give a figure where the yields have to shift to when you start really aggressively buying. But what's your expectation in terms of timing? When is this process, do you think, kind of like at an end where we have this plateau?
Yeah. So I think 2023 is gone, and probably part of 2024 will be, at similar levels where we see the market right now. So I'm not super optimistic that it will change immediately, starting 1st January 2024. But I feel that confidence is coming back. Networking a lot over the last couple of months, speaking to investors, speaking to banks. I don't think the mood is necessarily bad, but I think the market needs still some time to correct, and this I think will happen in 2024.
Are there other markets where you think they made it better? They're already ready to invest? You look at the whole Europe.
I mean, we are doing investments in other markets, and we are looking at new opportunities in those markets. Since we haven't sealed them, probably it's too early to speak about it. But I can say in some markets it happened already. So sellers and companies have realized that the old world has come to an end. There's a need of capital, and sale and leaseback is a source of capital. And we have been approached either directly or through brokers and agents, to look at those markets.
Mm-hmm. Interesting. Okay. Anni, maybe from your view, so you said, it takes a while as well. So what's your timing wise to 25 to 24, or even like now at Expo, you do something else?
Yeah. First of all, to mention what is readily available. So I mentioned that we are ready, and it's about ready now to go into credit. And we have 70, 75, 80 million equity to spend on our senior living platform. So when we stopped investing into office and logistics, we took the time and set up this senior living platform, and also something which we really there is a need for. The demand is huge. It was not easy to spend a lot of money so far. Yeah, we all know about what has happened in the market with the operators and all the things we have seen, rising rent, not staff costs in the nursing homes and all that kind of stuff. So that was difficult, but we like to spend this money as quickly as possible. And we are looking into also into student accommodation. Perhaps we will look into residential, but when I say we are just exploring this means it takes more time. So within the next 12 months, we will not spend money, but we will spend money on senior living and on credit. Yeah.
And do you get together with other Middle Eastern investors to see a little bit what's their mood? So do you get some feedback also from there? So others of your peers also having this view, or are they more bullish?
Talking to market participants from the region, I think the money will not go into Germany, to be honest, or not very much. Yeah, I think it will go to more dynamic markets. Yeah, let it be Mexico or India. Yeah? So with very different, perhaps a little bit more emerging. Yeah, that's my personal opinion, though.
Okay, good. And Marion, a little bit from your side. So you were very active and you're still looking. When do you think is kind of like the market at the right spot again to invest? There are a lot of people again coming to the market. So what's your prognosis or view, house view?
France is driven by offices. So one really important point for us is to see how the tenants will behave. For now, they start the renegotiation to reduce the area as there is post-COVID home office, there is flex office, there is whatever you want office. So at the end, people are not coming back to the office, so they want to reduce their square meter, but not everywhere. So now they are looking for centrality just to kept to be sure that all the talent will stay and people are coming back to the office. So one point is this one. The other point is there is a psychological impact of the financing situation. Just financing at more than 4.5% when 18 months ago it was free, almost free. It's frustrating for most of the investors, so they just stop. Maybe in few months, when they will see that the world before wasn't maybe the real one, and the almost 0% wasn't LC, let's say even LC, they will start again to use some leverage over 4%, and the market will start to be more dynamic. So I hope, let's say in mid 2024, maybe the end of 2024, the market will recover and start again, not on the same basis than in 2019, but on new one and maybe healthier one.
But selectively, every one of you wants to invest, so that's something I think we should have here. I would like to ask a final question actually to everybody, because we have now Expo next week, yeah, and I would like to know. So, what is the product, if you get offered it, size, credit, size, risk, or whatever, you would be able to transact this year, Anni?
Credit. Yes, a whole loan.
What product? Yeah, office, retail, whatever, logistics.
Safe, risk-adjusted product. Yeah. So, yeah. And office not excluded.
Not excluded.
Yeah.
Good, Marion.
It will be a digest volume, something between let's say 20 and 60 million in a really good location. It can be, to my point of view, something that we know well, so it can be retail, offices. So we won't go to exotic locations, so and exotic asset classes, and with a net initial yield good enough to enjoin us to invest. So it will depend of each fund. We've got several ones, so let's say 5 will be our minimum, but really the minimum. And if we can go over 7%, we will be more than happy.
Paolo, probably the same for you, huh? 7% plus?
Similar. But you asked the question, transact this year. I don't know if this is going to happen this year. So due diligence processes have become quite lengthy, I have to say. But, we would pursue it this year if it matches our investment criteria. So single tenant, long lease, critical property, in an acceptable location for that property, obviously, then we would look at it. And it can be all type of asset classes. It can be offices, it can be retail, logistics, light industrial, senior living.
Great, very good. And you, Wolfgang?
Well, I would say firstly, more pipeline in our existing joint ventures on logistics. So good located logistics sites, where we can build modern green product. Secondly, we would like in our existing partnerships on office brown to green to see pipeline in Munich and Berlin, roughly 10,000 square meter buildings, good bonds, which we can transform to something which resonates with the new world of our clients, i.e. the tenants. And thirdly, I would like to hear at Exporeal more about relationships, sourcing relationships, which we can then also foster for the next level of our value add fund series, and where we can deploy at scale, preferably in the living sector.
Great. Very good. Cool. So I think, time is running and we want to have an interactive part. So again, this is now starting. So the ones who still have a question in mind, please put it in the system. We already have a lot of questions and we'll try to answer from the panel as much as possible. I will just start now with the first one, which is interesting. Is Germany becoming more interesting for investors in the course of ESG due to its stable political environment? So in the course of ESG, because it's stable, you're looking at a lot of sustainability, Wolfgang. Is this something you see connected to the political stable environment?
Well, first of all, I would say the reason why we want to grow in Germany is because we think that Germany is clearly missing its decarbonization targets. So there's actually something to be done here. And I think we can probably all agree on that, I think in the end, if you look about legislation, what's much more important is what already has been implemented on European level, the taxonomy, And so I think we all feel that we need to do more. So in that sense, I would say, yes, Germany is an interesting spot to talk about ESG. We talk more about decarbonization, and we definitely need to get moving on that topic.
Right, and maybe ESG is interesting. Marion, what is the value of ESG, or how important is it in your process at the moment?
For us, it's critical. We've got several funds. Some are labelized, some others are not. But for each now acquisition, we need a prospective plan for building improvement, a short-term improvement. So the good thing in Germany, we've got some capacity about that.
Good. Let's move to the next question. And I think on this one, Marion, you already gave some view. So what is the panel's view on B and C investment markets in Germany? So you said A, B cities, you're looking for. What is that, Paolo? Are you interested in where is it located, if it's a great tenant?
We are. So the location needs to fit the property, or the other way around. We need to understand why our tenant partner wants to be in that location. This could be the workforce. This could be, smart people, you build up as a workforce over the last year. So it makes sense for you to be there. This could be your client base. So for us, it could be very interesting to invest in a B or C location, or even D location, if the overall it makes sense for our tenant partner to be there and to decide to be there for the next 20 or 30 years.
And Anni, if you do credit, I mean, if it's really a great tenant, is it so important where the property is located? Would you also go to
I would like to go back to the fundamentals. So we would prefer to stay in the A cities. And the good thing is that in the past, before any yield shift, you could not afford the A cities, but now you can afford the A cities again. And when it comes to credit, perhaps it's a little bit different, but first of all, I would prefer to stay in the A cities.
Okay. Wolfgang?
I think the question around the BC cities, for me, it's really, well, one, as Paolo rightly said, it's really dependent on what your mission is. So if your mission is to explore kind of the maximum liquidity points, for example, in offices, you probably kind of struggle to be invested in B and C cities, especially when you're in a closed-ended fund structure. But quite honestly, I think we are an urban investor, and there's plenty of good urban environments out there, and this is why Germany is attractive to investors, because it has this depth which you can explore. So if you have the duration, if you have a good strategy, identifying why you are in these spots, then I think definitely being cities are on the radar. For us, it is really broken down into the individual themes. For offices, it's much more because we are closed-ended, more in the A cities, yeah. But then for logistics and for living, it's a completely different location analysis. It really starts with where your tenant wants to be, yeah.
Great. Do you want to comment on this further? No.
No, I perfectly understand what you said. In our point of view, as we need cash flow and long-term cash flow, for sure, if we get a single tenant in a B or C cities, even if for now the location is relevant with their strategy, we can't afford to take the risk that in 10 years it's not the case anymore and the building doesn't have any rental liquidity after the departure. So as we don't have exactly the same strategy, for us, A and B cities are critical.
Great. I do the next question, which is, how does the panel judge the future of office use and office investment in general and in Germany in particular? I think we already heard some of that, but comparing it to other markets, Paolo, it's interesting. You also have probably a lot of US view on that. Do you think US will be much worse and Germany will be less, or what's your view?
Look, I think this is country specific. I probably wouldn't focus so much on the US now to comment on, but European countries and European cities are also completely different from each other. I think what's going to happen on the office market depends also a bit, how people act currently. Just COVID, etc. Obviously, there was a time where people couldn't really travel and go to the office. I don't think everybody liked that situation, for every day. I think some people would have loved to be in the office and see, other people as well and communicate with colleagues in a different way than, having video conferences. I think the office is still a place to meet, and I think people want to get to the office. But then it also depends, how much do you struggle to get to the office? And, not all cities have problems there. So, you can be in the office in 30 minutes, and that makes a difference if you commute 2 hours to the office, and probably then you enjoy much more to stay at home and be there. Or if you commute only 30 minutes to get together with your colleagues and speak about business, in a coffee break, or just when something pops up and you want to ask that question. So I do think that makes a big difference, in Europe and probably also beyond Europe.
Okay, here's a direct question to you, Wolfgang. How likely does Wolfgang sees it that he can actually build scale by partnering with operating partners? 99% of the cases, such strategies fail to get the scale, as buy and build does not work. What are lessons learned from previous JVs with such strategies?
Yeah, well, look, I think it is true, that when you are in partnerships, pipeline is critical. So at the moment, what we do see is on the partnerships which we have started, that they're producing good pipeline. They're producing probably more pipeline than we would like to do immediately. Because some of that we only want to go for the best at this point in time. Am I concerned about those partnerships not delivering? There's always that risk, because these partnerships, obviously we don't buy into land banks, and we probably also wouldn't want to buy into land banks because some of that would have been quite difficultly priced, given where markets have been in the past years. So I think for us, these partnerships, they need to be very well diligenced, in terms of the ability of the partner to produce pipeline. And it's not the only way to source. What I didn't mention, because it's probably kind of too far-reaching for this forum, is that we also are quite active in the corporate space, buying into platforms. Just bought into a majority stake with a logistics developer, majority stake with a residential developer, and they had a very strong pipeline attached to that, which we will build out in the next years. So it is always a struggle to invest at that level. It's unprecedented because historically value-add funds have been much smaller. And this is exactly the reason why you need to explore new ways by partnerships and by corporate deals.
I see the time is unfortunately running out, so maybe one last question. As I'm standing in front of the Brandenburger Gate, what is the panel's view on Berlin? Berlin was always, from international investors, very thought after. Anni, what do you think?
Now I'm the first one who has to answer. Yeah. So first of all, I'm a believer in all the big cities in Germany. Yeah. And also when it comes back to office and whether there will be a lot of investment or not, I think in the big cities there will always be enough tenant demand, and there will always be enough staff who wants to go there and like to work there instead of working from home. And Berlin, I think was a little bit over exaggerated over the last years, and it has to find also to find a new normal, and perhaps it's a little bit more back compared to other cities in the correction. Yeah.
I will stop it here because our time is running out. And thank you very much for answering all those questions. Yes, I think it was great. And also thank you, audience, for bringing in questions. We unfortunately couldn't answer all, but it's just, happy to reach out to me later on. Happy to answer this. So, I think now we're coming to end, and I will make a quick summary here. So we heard a lot about the international view on Germany, and what is clear is to regain momentum in this market, we need some drivers. I think international capital can be one. It will be not the one who changes everything, but if you looked at our figures in 2019, it was about 30 billion they invested, and this was a time where we had a market where Anni said not attractive anymore. In terms of pricing, because it was too expensive. Now we have this shift in yields, definitely, and it's on some markets it's going forward. So it will be more interesting. There will be definitely capital being invested with special approaches, such as good cash flow in A and B cities, single tenant, ESG, credit, urbanization, all those things. So living logistics, but we also heard there's everybody here also looking at offices, and it's not that like some think about it. So I think this is a very good round we had, and we had also some positive vibes. In terms of timing, it was clear everybody thinks it will still stay on a little bit to find the right pricing, but selectively there will be definitely deals, and I think for 2024 it's not bad. I think we should take this positive vibes into Expo and back concentrate on the opportunities that can work in this market. Great. To wrap it up at the end, I would like to thank once again all my guests here in this ground. It was really interesting information you gave us, and also little discussion. So that was really good. Many thanks for all the viewers of this session. We will continue our live talk series tomorrow morning at 10 a.m. CET. My colleague Matthias Leuber will host this with the topic Economics, Real Estate. What should investors do now? And the session will be held in German, focus on this connection with the economy and the real estate investment market. And the guests are Christoph Reschke from Heinz, Nils Kaufmann, Jamestown, Konstantin Plenge, LCN Capital, and Andreas Trump, our head of market intelligence and foresight. I wish you many more good ideas from our sessions here, and use it for your business. And thank you much for being here, and see you hopefully soon, maybe next week at Expo. Thank you.